Thank you. Next up, we have a panel discussion, digitization and the efficiency tool set for private markets. Anthony Woolley, Chair, GDF Private Markets Digitization Steering Group. David Newens, CEO, SDX. Richard Johnson, Founder and CEO, Texture Capital. Todd Stevens, Head of Capital Markets, Inveniam. And Dave Hendricks, CEO and Co-Founder, Vertalo.
Okay, good afternoon. What a fantastic conference. I think Mike and Juliet Media have done a great job putting all this together. I particularly love the way they book the weather. That takes talent as well. So I think we have a great panel for you today. There's been some great sessions all day long. Just to introduce myself briefly, so I spent 25 years working in public capital markets, and had a really good time. We went through the whole electronification of the public markets. And it was about 6-7 years ago I started getting involved. I was working for a big derivatives house, SocGen, and started to discover what was going on with blockchain. And also there was a very emergent growing fintech ecosystem in London. And ultimately I left my role as Chief Information Officer, Chief Innovation Officer of SocGen 2 years ago to join Ownera. And the reason I did was that I believed that private markets were going digital, right? We'd seen what had started to happen with security tokens, but it needed a couple of things. It needed institutional engagement, it needed distribution, and you need those ingredients before you can bring high quality assets to investors who we know are out there that want those high quality assets. And the approach we took is we took a very open approach. We felt the way to do this was to bring the industry together. So I think you heard referred to by Emmanuel and Graham earlier on. I co-chair a group under GDF, Global Digital Finance, with Lawrence Wintermeyer, who's here somewhere. And they're doing an amazing job to promote an advocacy for digital finance at a global level. So we now have a group of over 70 institutions from the large buy side, sell side, exchanges, FMIs, or what we would call TradFi, but working alongside all the fintechs in this space, law firms and others to make that vision a reality. If you felt you were missing out earlier because you hear everybody referring to this group that we run every 6 weeks or so, and you're committed to digitizing the private markets, do contact me separately and we'll see if we can get you an invite to the next meeting. Okay, enough of me. We have a great panel. I will let each of them introduce themselves in turn and let you know what they're doing in this space. So starting off with Todd.
Thanks, Anthony. Like Anthony, I escaped centralized finance after 25 years and found my way to this side of the pond. I look after capital markets and corporate development at Inveniam. We're an operating system for data. We have financial institution clients. We solve current pain points for each of those clients. And also what we see is we want to be the data layer for this digital asset economy that's evolving. And we really appreciate the ecosystem that's growing in the comments that you mentioned earlier.
I'm Dave Hendricks. I'm the CEO and co-founder of Vertalo. We're a digital transfer agent that connects and enables the digital asset ecosystem. We also run an amazing conference in Austin, Texas. The next one's in May. 400 people will be there. I expect also a bunch of the folks here and also the Juliet Media folks to be there too. So you heard enough from me though.
Hi, I'm Richard Johnson, the founder and CEO of Texture Capital. We're a FINRA member broker-dealer focused on digital asset securities. We help our clients more efficiently participate in digital markets by providing tools for tokenization, issuance, and secondary market trading through our SEC-registered ATS. I started the company back in 2019, spent plenty of time dealing with the regulators to get our licenses. We've been live for about a year now. We did our seed round as a security token offering or digital securities offering, and we have about 4 other deals on the platform right now. We are 100% focused on private markets, and I think it's a great. I think this technology is perfect for private markets where there is no market structure right now. So I often say that what we're doing here is building a new market structure from scratch using the best technology available.
Good afternoon. I'm David Newens. I'm the CEO of SDX, which sixth group being the FMI provider for Switzerland. So SDX is the first fully regulated financial market infrastructure provider to be issued with a license to operate a CSD, an exchange on DLT technology. And then I'm talking to nobody but myself. This doesn't work either.
Ready?
Does this work? Yeah. Awesome. Right.
I'll hold this.
Thank you. Thank you. So I'll start again. I thought I sounded very timid. So I'm David Nunes. I'm the CEO of SDX. SDX is the sixth digital exchange. So we are the first FMI to be granted a license to operate a CSD and an exchange on a distributed ledger. That was granted by FINMA in September of last year. First regulated FMI to actually issue a tradable security, the sixth digital bond, which settled in November of last year. Been conducting lots of exciting CBDC experiments with the Swiss National Bank and the Bank of International Settlements Innovation Hub. So feel very much like we're on sort of the tip of the spear as an FMI provider in this particular space, but really very grateful to be up here today and looking forward to this conversation.
Okay, thank you all panel members. So I think you can see this panel is a reflection of where we've got to in this digitization journey, right? So we've got a number of people here that spent many years, as I have, in the public capital markets, and that went through its digital transformation many years ago. Let's say in the 90s, we were replacing paper tickets in the front office of banks, and then driving that whole process of securitization, taking the public markets digital. It hasn't yet happened in the private markets, in spite of the things we've had with security token offerings the last few years. And people talk a lot about technology, they talk a lot about regulation. Just to level set, where do we think we are from digitizing the private markets from a tech and reg perspective? Are they still barriers stopping us making this happen? Who wants to kick it? You look like you wanted to kick off, Dave.
Yeah, I think that significant friction still exists, but it's far better than it was 2 years ago, 20 years ago. I got my first securitization experience in 1994. I was working on a project, a joint Goldman Sachs, joint venture with a company called J.E. Robert, and we were cleaning up the mess from the U.S. S&L crisis. It was the U.S. government created this thing called the Resolution Trust Corporation, and we were disposing of orphaned real estate assets. And we were using spreadsheets, Fox Pro, and I was traveling between banks, and I had to set up my own fractional T1 network to share information between banks, and it would take months to make a trade happen, like to sell an asset. I think we're now much more efficient. Okay, in private markets, you've got Forge and second markets, NASDAQ private market. There's a lot of interesting businesses out there, but the ecosystem is lighting up, and that's happening right now. I know for a couple of years it's been like, yeah, it's going to be this year, but it is actually happening right now.
And David, you're in Switzerland, so there, in terms of navigating tech and reg in that space, where do you see that you're at now in terms of production and being able to drive this?
I think that we're very fortunate in Switzerland in that we have a pretty well-informed regulator, and I think I would say that the experience of working with FINMA to get the license really helped educate them as well and got them up to speed about what the capabilities of the technology actually represented. There's I think there's regulatory clarity in that marketplace, which is certainly helping sort of grease the rails when it comes to expanding this ecosystem. Obviously, that's not the case across all jurisdictions, and it definitely is more challenging in other countries than it is in Switzerland. But I think that what SDX has achieved so far is sort of a reflection of the fact that the Swiss environment is pretty conducive to this sort of to this innovation. And that's why we having done the initial bond issuance, with more bond issuances in the pipeline, private markets is something which we have very much got our sights set on as sort of as a further expanding that ecosystem. But I echo what was being mentioned earlier, and it feels like the pieces are coming together. Both there's regulators who are getting more on board with this, and also we're seeing the appearance of infrastructure, which an interoperable infrastructure, which will enable this sort of this ecosystem sort of to actually emerge. But it's always difficult to see it before it actually sort of begins to get the connections in place, because it isn't an ecosystem until those connections are in place.
Yeah, indeed. So when you say other countries, maybe let's talk about America then. So a theme today is people with British accents based in New York. So Richard, tell us about the US and where you are, texture capital.
Yes, I think Hello, yes. So I think your question was about a couple of things there. Are there any kind of technology or regulatory hindrances? Well, the technology is way ahead of where we are right now. If anything, we have to take functionality out of the tokenization in order to comply with the regulations. That isn't really necessary. And I think the last, or a couple of panels ago, it was a good regulatory panel, kind of, looking at the, I guess what I'd say irrational fear of blockchain and tokenization that seems to be coming from US regulators. So I don't want to go into that too much, but I want to look at it from the other side of it when we're talking about kind of, digitization as an efficiency tool set. There's the other thing that I'm very disappointed in the regulators here is that it's the irrational, I guess, underappreciation of the benefits of the technology. So, we see lots of kind of, the SEC wants more transparency in private markets. They want to know what's going on. They want to protect investors. They want fair and orderly markets. These are all things we can provide with the technology, and they're not embracing it. They could operate nodes on a blockchain. We'd be, we were regulated by the FINRA and the SEC. They come into us. They do an audit. They get all our books and records anyway. They could have that on the blockchain, so that there's they're missing a lot of advantages that I think would be beneficial to them and to the market and to investors as well. So there's definitely more to do there.
We were hearing earlier, right, how cap tables of private companies we're saying are on spreadsheets. A lot of the time they're still on bits of paper, right? And they're, I heard some stats the other day, VCs, they're never right? When they're going through around, they're scrambling around trying to work it out. If you're taking a cap table off a spreadsheet, that's got to be an improvement, right?
Yeah, well, I think I heard a story about Uber when they went to do their IPO. They spent, millions on lawyers and months trying to sort that cap table out.
Same with Facebook. It was like $50 million.
Yeah, sure, Greg knew all about that one. Todd?
Yeah, so I agree that I don't think we have a tech issue moving everything forward. And I think regulatorily, I think we're moving forward. I know there's obstacles and there's some own goals being scored. I mean, what I look and see is I think there's certainly a liquidity issue or a liquidity obstacle, but I think we boil that down to more of a trust obstacle as well, because in the traditional financial markets, there's always a saying that fixed income was bought and equities were sold. That meant that there was always a structural buyer for fixed income, whether it was a pension fund, government, whatever. I mean, and again, maybe the fixed income guys shouldn't have got paid as much as the equity guys, but like equity was always sold, and we're talking about private equity, private markets. So that's a more nuanced sale. So I think we kid ourselves if we think people are just going to rush in and buy. I think we have to educate them, give them better data, give them better access, and help them along that journey. Because the sell has to be more compelling, because you need trust. I mean, you either get trust from people buy because they trust their friends that are selling it to them, or that manager, KKR, that's selling it to us, or there's a community that we're buying into, or you just do your homework and you have the ability to do that homework. So I think the level of trust is definitely needed, and we all can play a role in making the data more available for decisions to be made, and I think that will help unlock some value.
Yes, that leads the discussion nicely on, because so it's not technology, it's not regulation, right? But tokenizing an asset, right, doesn't instantly make it liquid, right? And you start to touch on this, Todd. But so what are the main elements that you feel we need to get that liquidity, to increase the liquidity in the private market space? I'll come straight back to you, Todd, because I know you.
Yeah.
something on this.
So I'm going to sound like a broken record here. So again, trust, and when I say trust is, I think trusted data. You need trusted data that leads to better valuations, which leads to more liquidity, which leads to more trading. And again, we're purely focused. We're heavily focused on valuation. I think Pat's mentioned that we think valuation is the killer app for blockchain. So we spend a lot of our time not only on the right side, kind of educating giving data to investors to come into the market, but really we spend a lot more time even with enterprises bringing them to the blockchain. And when we do our sales to people like a BlackRock or Cerberus or KKR or other institutional investors, we sell valuation, which is a pain point that they currently have. They get third-party valuations maybe once a year. I think 80% of GP assets are self-valued. We think that's going to be an anathema in 5 years. It's going to be like self-custodying in institutions. I think an earlier panel mentioned post-Madoff. Obviously, institutions can't self-custody. We think that GPs will not be allowed to self-value. And so we think valuation being the killer app. When I say that, I mean that like when we do our service with them, they actively anchor to a blockchain. And that's a maybe small step, but I think psychologically a big step. Like if a BlackRock is anchoring to a blockchain, they're getting over a step that's leading them right to the doorstep of tokenization.
Yeah, but I'm gonna have to take issue with that. I think that the excess focus on the technology, the nerdy stuff, is actually the biggest friction. You know, when you go and post a cat picture on Facebook, you don't care what database they use. You don't need to know anything about the database. And so I agree that the technology is not the impediment, but the technology is the impediment. Because as long as we focus on all the nerd stuff and make it look like it's difficult, and we're driving people away because they don't trust it. They think that, you know, you say tokens or you say blockchain, half the people think that you're running a scam. Really what, you know, if we're successful here, the technology disappears and the benefits are in full relief. And
Like the public markets.
What?
Like the public markets
Well,
operate.
yeah, like the public markets. And then the other big point of friction is the quality of the asset. Sure, you can value the asset, but you know, an early stage asset's impossible to value. There's a real emphasis on using this security tokens or digital asset securities as a fundraising modality a couple of years ago. That doesn't work. Okay, it just full stop doesn't work. Using this technology to take mature assets which are not big enough to go public, or where there's no marketplace like real estate, using this technology to make them more liquid is the killer app, okay? But it's gotta be like some crusty 75-year-old investor or real estate owner has to be able to get their head around it and trust it. And they don't wanna know about any of the nerd stuff.
Too right. But it's not so much about the technology as the usability of the technology, right? I mean, we're not gonna succeed if your average investor needs to know how to use a MetaMask wallet, right? But isn't that when you've got institutional engagement, isn't that being able to put tools in the hands of investors that they understand, to make them easy to use, to extrapolate that away from them, no?
So, I mean, your question was that, you know, just because you tokenize it, you don't instantly get liquidity, right? No, you need demand for liquidity. You need supply and demand. But that demand is out there. We talked about Forge a minute ago. They IPO today. They got something like a $2 billion market cap. And they are a secondary marketplace for private shares. But they're definitely not tokenized. They're not really even digitized. You know, they have an ATS, but there's a lot of, you know, perhaps a more efficient way of shuffling paperwork around. We're trying to solve that by tokenizing it, putting the cap table on the blockchain, applying smart contracts so we're automatically, you know, following the regulations in whatever jurisdiction we're in. So there's demand out there, and if we do things right, we're going to be able to create a better marketplace. Another statistic I just want to kind of add there is something like $180 billion of GP secondaries went off last year in private equity market. The demand is out there, and everyone's still doing it the old-fashioned way. You know, going back to what we've been saying, like the opportunity is just beginning to start. So I do think 2022 is going to be a great year for us all.
Indeed. So the supply and demand is there. The technology needs to be more usable. We've got companies bringing the data, so investors get the right information. more timely mark-to-markets, right, and price discovery, etc. What else, David?
I think public markets are helpful. So to your point about making the investor journey sort of as familiar as it has been, with public equity, is going to be also very helpful when it comes to actually the adoption of the asset class, when it comes to sort of tokenized private equity. So I think again, platforms like venues like SDX being available, I think is one step forward in that particular space. I would take issue with your taking issue about the technology also being an impediment, in that it is really nuanced, right? Because one of the things that we found is that once we got the regulators' head around the benefits of the technology, they got all enthusiastic about it. It's like, we think we have been able to eliminate settlement risk through atomic settlement. So that instantaneous settlement, no counterparty risk, and no clearing and costs and so on. That's something that FINRA has been sort of increasingly excited about, and therefore wants to see us being adopted by the marketplace as a result. So that's kind of helpful. It was also really helpful then when we went to go and say we're going to do crypto staking on a non-delegated basis, and they were like, "That's really cool too," as opposed to going, "What on earth are you talking about?" So I think that they are. I think it's sort of case dependent. I think, and situationally dependent.
Yeah, and it depends on who the buyer audience is for this stuff. When I talk about having the technology fall away and become invisible, that's really with regards to the retail investor, and they need to trust it. There's always folks in the banks or whatever who have a kind of hobbyist interest, or they're really into what you do, and they get into the blockchain elements, but I just think it should be invisible. If it's so then that's when the magic happens, when the technology just kind of falls away.
I think I'd agree with that in terms of the invisibility of the technology. Then the investors just need to make up their mind and have the tools to make up their minds. Absolutely.
Yeah, so such as putting a wallet in an investor's hand where they can see all the assets wherever they might be, right, and click to invest and trade in them. So we're talking about the private markets, right? In the public markets, you have exchanges in national exchanges. You've got enough liquidity there. You've got large pools of assets and investors. Private markets, we're talking about a global private markets, right? And bringing investors to assets wherever they may be. We've got investors in the Middle East wanting to access assets on the West Coast here, in Europe, out to Asia, and vice versa, right? So, and we have the example of public exchanges, local exchanges. The world of crypto is borderless, right? It's globally distributed environment. So as we take this institutional and really digitize the private markets, how do we get a balance? How do you get to a point where you're connecting assets to investors wherever they may be? David.
Well, you have an amazing technology platform, I understand, that enables us to link these venues together.
Yes, we do actually.
Yeah. Again, there are technology solutions that are in play that will achieve that sort of global liquidity pool from a technology perspective. But that doesn't mean we actually can achieve that from, again, a regulatory perspective, because there needs to be regulatory consistency to enable that to actually happen. So that so that any investor from any jurisdiction could access any private equity instrument from any other exchange anywhere in the world. That's definitely a nirvana state that the technology could support, but we need to get that sort of regulatory consistency to actually enable that.
But we're never going to get complete regulatory consistency at a global level, right? At the best, we've got regulators that are now going to principle-based regulation, but they'll all have their lawyers and their individual rules in each jurisdiction.
You'll need to have some sort of platform which will enable the ability to actually determine those different regulatory constraints, right?
So you want stake tonight? Basically, you've upgraded.
No, the good news is that the problem is the same everywhere. The markets are different in different countries, but the problem is the same. In every country, people own assets that they either want to borrow against or they want to sell, real estate or private equity. It's largely the same everywhere. I think that jumping ahead to trying to do cross-border, trades when we haven't gotten a volume of, trades just in a single jurisdiction, I think it's jumping a little bit ahead. but getting, like what FinP2P is doing, because he didn't say what he was talking about. He was talking about FinP2P, okay? FinP2P, Ownera, FinP2P. Being able to get institutions to effectively speak to one another, I think that's a great goal. But focus on the big markets, focus on getting good use cases, and then the next thing we do, we can create global liquidity pools. I mean, that's hard in public markets. You have ADRs and equities, and they're like different things. I think we should just always stay simple.
But, yeah,
solve the basic problem. How do we buy and sell these things?
Yeah, I mean, but it's not really the same. And I think a lot of people, I get really annoyed when people say, oh, with security tokens, we're going to have 24/7 global trading. It really annoys me because it's not going to happen. And because that works in crypto, because they're not operating within the regulatory bounds. A couple of examples. Yeah, we have ADRs, but how does that work? What happens is a European issuer issues securities to a correspondent bank who puts them in custody, then files paperwork with the SEC and issues new securities. It's not the same securities moving around. There's an ARB there, they're somewhat fungible, but it's not the same security, it's not the same token. So I don't know if we're ever going to get there. I don't think it's really worth, it's going to be so hard. I think, like Dave said, we just need to focus on building up this market here in the US and then see where we get to. There's always going to be that regulatory barrier. That's not going to go away.
But again, I mean, we're in the US, so it behooves us to say build it up in the US, but the supply and the demand will be in different places, and I think we have to work to get there. I mean, and tying the ATSs together in some way where there's a sharing, and maybe there's not a GDR of sorts, but maybe there's a synthetic GDR of sorts whereby these things can trade, and 24/7 trading. I mean, that's not a regulatory restraint. That's just kind of markets open and close because that's the way they always have done it. And there's liquidity. Yeah, I agree with that.
I'd also, I think it's a bit of a different sort of situation you have here in the US because of the size of the market. So in Switzerland, we have to look to sort of to see beyond just the borders of the country. So there needs to be a way to have investors from other jurisdictions be able to access the issuances as well. So otherwise, I think it's not as attractive as it wants to be. I mean, Switzerland wants to be that sort of an international hub for private equity, but doesn't think that it can stand on its own without actually having some sort of ability for foreign investors to also access the marketplace.
I think it's a great idea to enable people from all over the world, travel rule compliantly, to be able to purchase assets on Texture or SIX or anything like that, but cross-listing and saying, oh, okay, well, I'm going to issue here in the U.S. and you can buy my stuff on all these different places. That reduces bid density, and the biggest, if you want to create liquidity, the buyers and the sellers need to know where to go. It's really interesting here. I'm not sure what the exact number is, but there's about 60 or maybe 70 CMAs, either complete or in process, for alternative trading systems in the United States. There's not nearly enough volume right now to support 5 or 10 ATSs yet. And so if we, again, skip ahead to multi-listings of a single security in multiple countries, I think we're going to continue to dilute the pool of buyers, and that's going to have problems on price discovery and all kinds of other things.
I don't think it's like everything everywhere. And again, so we have a joint venture with SPI Digital Holdings to roll out an exchange in Singapore, because that's a very natural sort of a natural ally from a reg perspective with Switzerland, and has been historically. So I think you could have placed you fight your battles in the appropriate places to actually expand that out. But yes, not just absolutely everywhere for everything.
The opportunity with the private markets, right, is that it is offline, that we are dealing with a clean sheet of paper, for want of a better word. So we don't have to carry across all those preconceptions from the public markets, the idea of trading sessions or cross listings or whatever, right? In principle, you should be able to have a private asset and give access to it wherever the investor might be globally, right? So the asset might exist in a place, but it surely is about getting access to that asset to investors, right? Okay, very good. I don't know, I've got a few more questions, but I just wanted to see with such a great panel here if there are any questions in the audience, just to stress people running around with hand mics or whatever. Any questions for the panel? We got any for the moment? No. Okay, let's keep going. So you talked about trust earlier, Todd. So let's focus on the trust question for a minute. How do we build that trust in this ecosystem as we go, as we've removed each of those other barriers?
Well, I think there's this building blocks for trust. I mean, the investors need to know what they're buying. So we need to be able to show them what they're buying. Looking at audited financials are great, but that's a little bit of a look-back mechanism. Looking at a current valuation is better, maybe not perfect, but it gives a sense of potential relative value. So just giving more constant information on the asset and keeping it up to date, I think is going to be really important for building trust with the investor base. And then getting the kind of the people to come into the ecosystem, the enterprises, because I think we desperately need enterprises to come into the private markets ecosystem. Again, that becomes a lot more of a kind of a show me regulatory pattern recognition of the. It's more of a pattern recognition from TradFi to kind of what we're looking at in the digital asset world.
So, I mean, giving good information to investors is a major step, right? So that they can feel they understand the asset that they're potentially going to invest in. But you need people standing behind that maybe as well from an institutional point of view to represent those assets, I guess.
Well, I don't think we're going to have the banks that are going to set up trading desks that are going to trade this back and forth. I think the regulators have put capital rules in place which make that kind of impossible. But we will see hedge funds do that, and they might be the liquidity providers.
Now, I agree with what Todd said about trust in terms of valuation, and that's a kind of a retail-centric concern, right? Do I know what I'm buying and all that sort of thing? But that's demand side. The supply side is the real issue in this business. Investors will always seek out alpha. They'll seek out great returns and great assets, and they'll find them. And they spend a lot of time looking for these things. Professional investors. It's not the investor. We don't have an investor issue. What we have is an asset and supply issue. And until the issuers and these are issuers with assets worth $500 million, $1 billion or more, are willing to place those assets into this new kind of ecosystem. Until that happens, all the demand considerations don't matter, because we did a study last summer. I had a team work on this, and we talked to thousands of VCs and board members, and we found that there's 15,000 U.S. venture-funded companies between 50 million and $1 billion in market cap. Maybe 5% of those companies will ever have a shot at going public. Until VCs will allow their founders to list their shares and then have a successful transformation and be able to sell on something more efficient, more broad-based than say a Forge or something like that, we're going to have trust issues. The trust is going to happen when the asset owners or the boards of companies say, this is a great way, this is a great tool to use, because M&A is getting bought, IPO is really hard to do. When that starts happening, and that happens at scale, the buyers are going to come because they want to buy into these companies. They want to get companies before they're overvalued. They don't want going public is a down round, and for a lot of companies. And
I think I saw somewhere the round before the IPO has 6 times the value of post, right? So we're talking about these pre-IPO companies. We were listening to Greg Brogger earlier from Forge, talking about, companies are staying private longer, right? In fact, companies generally would prefer to stay. Yeah, they'd prefer to stay private if they could get the liquidity, right? Stay private and in control. So maybe it's providing that capability to those large private companies.
I was just going to say, it sounds like a good advocacy project for GDF to go to these issuers and get them to kind of like change their ways and kind of open them up to listing on digital asset exchanges. I mean,
yeah, which is about working with the companies as well, right? So as Greg was saying earlier, you know, maybe in the past these secondary venues for private securities weren't working with the companies, right? They were going to try and find stock from employees in spite of them. So I think, you know, now we've got these companies staying private longer, it's basically showing them the benefits and them wanting to attract that liquidity. Yeah.
I got a few things to say on that. So first of all, I think that Dave was right. I think 14 years is the average age of an IPO, of a company with IPOs. You know, Airbnb was notorious for not allowing secondary sales or private sales. And what ended up happening there is that employees left $4 billion of unexercised options on the table because they couldn't afford, because when you exercise the option, you've got to buy the stock within 3 months, or whatever exactly it is.
You have to pay tax,
Pay tax.
On that stepped-up valuation.
And they couldn't do that. So they left $4 billion on the table. Small private companies are, I think they represent 95% of jobs in the country. And everyone, and you know, we're all here competing with, you know, we're in Silicon Valley, we're competing with Google and Microsoft, who are offering rich options packages that are liquid. It's very hard for private companies to compete with them. So now going back to the trust thing, how do we get companies to have more trust? And I understand, you know, I'm a founder of a private company. I don't want all my private information out there on the World Wide Web. But we can build tools, we can build gates so that only, you know, qualified investors are able to see certain types of information. And we can also, using tokenization, we can build functionality into the matching engines and into the smart contracts, so that if somebody says, well, I'm thinking about, you know, letting my private company stock trade, but I don't want anyone to get more than 5% of the company. Okay, we've got a digital layer. We can program that in. Or they say, I don't want anyone to get on my cap table for less than $1 million. Okay, we can program that in. And that's something we've done at Texture. We've created all these controls, we call them issuer controls, to make them more comfortable and try to eliminate the ROFR or make it a more deterministic ROFR. So there's a lot we can do here.
And this is a retention tool, if you think about it, right? If you know that you can sell part of your holdings every quarter, even if it's only a window. The thing about this is that there's a real social good here. A lot more companies will get created, a lot more houses will get built and bought, a lot more kids will get to go to school. There's amazing things that are going to happen if the supply comes online. This is actually a really, really great thing for society.
Yeah, I mean, when we talk to CEOs of large private companies, right, they have a problem with talent retention in the context that, you know, they've got great companies that people really want to enjoy their jobs working for them. But if they go to a public company or Google, you know, their shares are immediately liquid. So these are the sort of things that the companies want to be able to say to their employees, right, you can convert 10% of your shares every year to a liquid form, distribute it, have a secondary market.
So that they're not indentured servants.
Yeah, a lot of the time it's kind of, they write it off if it's in a private company, and we don't want them to write it off. There was a question.
But before that question, I mean, I think the supply, quality is needed, no doubt, but it's a massive supply potential, because it's not just private companies, it's commercial real estate, it's funds. There's a lot of other assets that should be trading on these private market exchanges.
Sanjay.
Yes, thank you very much. Dave, you mentioned that the supply should come online. So I'm part of TIE, the Indus Entrepreneurs, which probably has about 4,000, 5,000 companies in its full network between, you know, with revenues between $100 to $500 million in revenue. And knowing most of those entrepreneurs, they don't want to come to the market because they think that the value that the market will give them, even Forge, they refuse to go to the Forge because the value that they'll give them will be at heavy discount. And that is why the transparency on the valuation will allow them to have a better price. The DLOM gets reduced, so discount because of lack of marketability gets reduced. And there are research studies saying that if you can give transparency on the underlying value of that company, it can actually, you can reduce that DLOM. If it's like 40%, you can reduce it by 10% or 15% or 20%. So I understand the supply, but it's a catch-22. If I'm not going to get value with it, why will I bring it in and just keep on getting the cash every year I make?
So, okay, so the whole thing that ATSs do, in my opinion here, is that ATSs are a mezzanine round between fully private and public. It's not, doesn't have to be an end. And eventually you have to get price discovery. VC valuations are spiritual. They're imaginary. Okay, a lot of times they came because of a bidding war, et cetera. They're completely, they're not necessarily based on fundamentals, or else Clubhouse wouldn't be worth $4 billion. Okay, and so yeah, there's a risk that if they allow their shares to be sold, that the price is going to be low. But right now, there's a liquidity discount already in the sale of shares. I think it's it's just something you have to live with. But it's the lack of marketability which creates the real illiquidity discount. And these systems like Texture and other ATS6, et cetera, enable price discovery, and that's a good thing. It's going to happen sooner or later.
And Inveniam supplying data on those private companies.
Yeah, I'd argue that ATSs are more than a mezzanine level. I mean, maybe for hot corporates, but again, I think fixed income trades on ATSs. I think you'll have real estate trading on ATSs. You'll have a lot of different assets that are always going to be private that'll trade there.
Very good. We're just about out of time. I don't know, one last question? No? Okay, well, thank you very much to the panel.